Noted short seller Jim Chanos built one of Wall Street's largest fortunes by predicting the falls of Enron and Tyco and by foreseeing the mortgage crisis. He's with us now to talk about China, his outlook for the markets, and his thoughts also on today's insider trading arrest. Jim, by the way, is president and founder of the $6 billion hedge fund Kynikos Associates. Jim, good to have you back with us.
Thanks for having me.
So what do you make of the continued investigation, this insider trading investigation, and it looks like they keep trying to link it up with hedge funds here?
Yeah, I mean, look, I think there's always going to be a few bad apples in the bunch, and I think Wall Street has its share. But what this looks like so far, anyway, from what I've seen, is pretty much standard insider trading, getting information from within companies, no matter what the vehicle, whether it's expert networks or direct insiders. And you
stopped, by the way, using expert networks years and years ago, right?
We did. We basically felt that the information that we could glean legitimately, we probably should be getting ourselves. That's what our clients pay us. So to pay additional dollars for experts, for information that could be legally gleaned, is what we're paid to do. And increasingly we felt that the services were being marketed in at best a gray area, which is that access to former executives. And that's when you begin to get, begin to get in a gray area. And I think we don't talk to, for example, to ex-executives of companies. We don't talk to current executives of companies.
What do you do when you're doing channel checks? I mean, you obviously look into a company and research it sincerely before you make a decision on investing.
Absolutely. But there's lots of ways to get information without actually talking to anybody who has a fiduciary responsibility to a company. And that at the end of the day is the strongest legal definition of insider trading. That if someone has a fiduciary responsibility, an employee, and even an employee with still ties to, an ex-employee with ties to the company, a lawyer working for a company, an accountant working for the company, you're on shaky ground legally. And that's what we were increasingly uncomfortable with the expert networks.
But that's your discomfort. I'm curious what you think about other folks. Do you think that there's a widespread use of these expert networks out there?
As long as there's profit to be gained, people will be looking for whatever edge they can get. And, as we know from the 80s and investigations subsequently, people sometimes cross the line. And that's why we're supposed to have securities cops on the beat.
How much further do you think this goes? We've been talking to a lot of lawyers and legal experts throughout the day here, and they do think the next target is hedge funds specifically. How much further do you think it goes?
I have no idea. But again, I think that as long as the allegations are sort of the plain vanilla insider trading that we're all familiar with from previous cases, I think they're on strong ground. But if the prosecutors begin to delve into the whole concept of what's inside information as opposed to who's giving it, I think they're on shakier ground. Because let's face it, the SEC has not really wanted down through the years to have a very tight definition of insider trading. They have liked to keep it as broad as possible, to keep people on their toes. So I think I actually personally, as a marketplace participant, would love to get a very tight definition of insider trading. And maybe that'll be one of the things that happens out of this, where you know where you stand, who can you talk to, who you can't talk to. It would be better for everybody involved, I think, as if we had a clear set of rules on that.
Is it likely, if you take into account everything that's going on in Washington right now, and it seems like there's somewhat heightened scrutiny, although with the midterms everybody's maybe starting to question whether or not that really plays out, do you think that we do see that? Well,
remember, you've got Dodd-Frank now, which is legislation, but the blanks have to be filled in by the regulators, by and large. So the regulators are going to have their hands full on a lot of things for the next 2 years.
But it's a great opportunity, as you say, to really come out and clarify the rules.
Well, for that you might need legislation, though, because it's laws. So I don't know, or real strong court decisions. I'm not an attorney, but I think that one way, shape, form, I think that would be good for the marketplace to get a sense of really what's right and what's wrong in securities trading.
How is the honor code? I mean, do you think most people are on their toes? Do most people, if they get something too good to trade on, kind of go the other way?
99.9% plus of Wall Street is honest, does their job with ethics, and trillions of dollars changes hands every day on people's word. A lot of people forget that. And it's one of the only businesses in the world where that's the case. And so, if you go back on your word forgetting legalities, you're out of the business in many cases. So the vast majority of people are doing their job ethically and responsibly. And, but as in any business, we saw it in mortgage lending, we've seen it in banking, there are people who cross the line.
Does it say anything to you, Jim, too, that the market's kind of shrugged this off, it seems? I mean, I know we had some good economic news today, but the market kind of seemed to ignore it for the most part.
Yeah, I mean, I think that the market is seeing this as a case of insider trading, and whereby you've got some bad actors, perhaps, allegedly, crossing the line and trading on information they shouldn't. I don't think that's necessarily an economic event, and I don't think it's really a confidence-shattering event. I don't think if you canvass most Americans walking on the street, I think they'd be hard-pressed not to think that there were at least a few bad people on Wall Street.
It doesn't shake. I mean, insider trading cases don't typically actually shake the market, right? I mean, when Boesky and Milken went away, it didn't pull down stocks.
Boesky and Milken were basically in the height of the 86, 87 bull market, and stocks kept moving ahead. Mm-hmm. It really wasn't until they actually brought down Drexel Burnham, a banking institution, in '90 that it had reverberations in the credit markets.